The last two statements were movies. The income statement showed a year of profit. The cash flow statement showed a year of cash movement. This one is different. The balance sheet is a photograph. It freezes the company at one moment in time and asks three questions. What does Redline own? What does Redline owe? And what is left for the owners? Read it right, and it tells you something the income statement cannot show by itself: how strong the company's financial structure really is. Let's read it. Before we touch any line item, one equation controls the whole statement. Assets equal liabilities plus equity. Everything the company owns was funded one of two ways. Either someone lent the company money, or the owners put money in and left earnings inside the business. That is why a balance sheet always balances. Not by luck, by construction. Every dollar of assets has a claim against it. Keep that equation in your head, and the rest of the statement becomes much easier to read. We start with assets. Assets are usually listed from most liquid to least liquid. In plain English, what can turn into cash fastest appears first. So the first line is cash and equivalents. Redline has about $4.2 million of cash. That number should look familiar. It is exactly where the cash flow statement ended last episode. And now we can answer the question we left hanging. Where did the missing cash go? Right here. Accounts receivable is about $36 million. That is product Redline sold and billed, but is not collected yet. The sale happened, the cash has not. Inventory is about $23 million. That is cash sitting in parts, work in process, and finished product that is not turned back into customer cash yet. Receivables and inventory are where a lot of the cash is hiding. It did not disappear, it turned into working capital. That is why the balance sheet matters. It shows you where yesterday's profit and cash flow landed. Add cash, receivables, inventory, and other short-term assets together, and Redline has about $66 million of current assets. Below that are the long-term assets. These are the things Redline keeps and uses to run the business. Property, plant, and equipment is about $38 million. That is the factory, machines, tooling, and other operating assets shown after accumulated depreciation. That connects directly to the depreciation we added back on the cash flow statement. Then come goodwill and intangible assets. Goodwill is about $52 million. Intangible assets are about $19 million. These are not things you can touch like inventory or equipment. They usually come from an acquisition. In Redline's case, they reflect value paid above the hard assets when the company was bought. Add everything together, and total assets are $178 million. That is the top half of the equation. Now we move to the claims against those assets. Liabilities come first. These are what Redline owes. The short-term liabilities are the near-term bills: accounts payable, accrued expenses, the revolver draw, the current portion of long-term debt, and other current liabilities. Together, current liabilities are about $32 million. One quick read here is the current ratio. Redline has about $66 million of current assets against about $32 million of current liabilities. That is roughly 2.1 times. So on paper, short-term coverage looks reasonable. But then we get to the real weight of the balance sheet, the debt stack. Redline has a senior term loan of about $63 million. It also has $22.5 million of mezzanine notes. Add the revolver and current debt, and total debt is about $99 million. That is the number you do not skip. It tells you how much of this company is funded by lenders. In Redline's case, leverage is about 4.3 times EBITDA. That is a very different story from simply saying the company is profitable. Profitable is good. Leveraged is different. The business may be performing, but debt changes the margin for error. Now we get to equity. Equity is what is left after the liabilities. It is the owner's stake in the company. Paid-in capital is about $42 million. That is capital the owners invested. Retained earnings are about $10 million. That means profits kept in the business since this ownership structure began. This is where the balance sheet starts telling you the ownership story. Redline has $178 million of assets, but only about $52 million of equity. The rest is funded by liabilities. That is not automatically bad. It is also not something to ignore. This is what a private equity-owned manufacturer often looks like: real assets, real earn.